The company being analyzed today is Goodluck India Limited, which manufactures foils, tubes, among other products, and is now entering into the defense industry with a new set of products. Today, we're going to analyze the company's financials, what the company actually does, like what are its products, and finally, its future outlook and growth outlook, especially with the new defense segment. So, let us start. First, we have a market cap of 3,449 crores. So, not the smallest company, not the biggest company in terms of market cap. Current price of one share, 1,038 rupees. Stock price to earnings ratio right now is 20.8 times. The book value per share, that is assets minus liabilities value per share, was around 422 rupees. Here we have the financial highlights of the company for the last 5 fiscal years. Let us first start with the revenue, total income or revenue in millions of rupees. So in fiscal year 2021, revenue was 15,780 million rupees or 1,578 crores. So you add a decimal point. So 1,578 crores increased to 2,617 crores, then 3,086 crores the next fiscal year, and finally, fiscal year 2025, 3,957 crores in revenue. So you can see a good growth has happened in revenue. Then EBITDA. EBITDA has grown from 122 crores in fiscal year 2021 all the way to 321 crores in fiscal year 2025. Then PAT or profit after tax went from 30 crores in fiscal year 2021 all the way to 155 crores in fiscal year 2025. And you can see here we have margins. This above one is the EBITDA margin. This lower one is the profit after tax margin. So EBITDA margin took a bit of a decline from 7.8% to 7.31% in fiscal year 23. Right now, bit of a rise, 8.4% EBITDA margin. However, profit after tax margin has increased from 1.9% in fiscal year 2021, then 2.9, then increasing to 3.7, and finally 3.9. So EBITDA margin has gone down and currently stabilized, while PAT margin has seen a steady increase, which is interesting. Earnings per share has also improved. Fiscal year 25, 47.39 rupees, to not much of an increase from fiscal year 24. It brings the question, was there share dilution occurring in the company, which is diluting the earnings per share? Now, what does the company actually do? Led by a first generation entrepreneur, okay, 5 lakh metric tons per annum of total capacity. Whatever products they produce, the total weight you can say 5 lakh tons per annum is the total production capacity. 2.85 lakh of this is high margin value adding products, and 2.15 lakh tons per annum of this is high volume products. And this is their defense segment or a part of the defense segment. Artillery shells. They're manufacturing artillery shells, 1.5 lakh of them annually under Goodluck Defense and Aerospace Limited, which is a subsidiary of the company. Okay. They got 600 customers and plus 100 countries of exports, and these are their segments: engineering structures and precision fabrication. Engineering structures, literally designing like structures, construction structures, and then manufacturing them. Forging products, literally making metals into certain shapes and sizes so they can be used in different industries. Precision pipes and auto tubes, coils, pipes and tubes, CR. I forgot what CR meant, I'm sorry. Then in quarter two fiscal year 26, upper right, see, alone, they sold 1.12 lakh tons of sales. That much volume they sold in quarter two alone. Okay, 997 crores of revenue in quarter two alone, 90 crores of EBITDA in quarter two alone. So current capacity 5 lakh metric tons per annum. Remember 1.5 lakhs artillery shells they're going to be producing. This is a new segment. This is going to be a new revenue, and these are their business segments. So remember that. Okay. Now, where is the money actually coming from? Which segment is contributing how much? Let us go to fiscal year 25. We will see the whole fiscal year 25. So largest revenue came from CR sheets and pipes. So the sheets and pipes they're producing, they're manufacturing, okay? That is 36% of revenue in fiscal year 25, followed by precision pipes and auto tubes, 25%, Then 22% of engineering structures and fabrications, and 18% is coming from forging. Sorry, 16% is coming from forging. It's remarkably similar to quarter two fiscal year 26. You can see the percentages are remarkably almost same. So each segment, of course, CR sheets is the most important, but each of the segments is important. They contribute good amount to revenue. Fine. Then manufacturing capacity. We already saw 5 lakh metric tons per annum, but where is this capacity going? So first of all, let's go to H1 fiscal year 26. This is the latest one. CR sheets and pipes is 2.15 lakh tons per annum. That's much CR sheets and pipe they can produce. Then precision pipes and automobile tubes, 1.7 lakh. Then engineering structures, fabrications, 85,000 tons per annum. And forging. So forging is the value added. Okay, so this is the value added, part of the value added product, 30,000 metric tons per annum. So you can see the distribution of the capacity. Then capacity utilization. What percentage of capacity utilization was happening? So in fiscal year 24, 93% slipped to 89% fiscal year 25, then currently at 90% for H1 of fiscal year 26. It's annualized, meaning H1, quarter 1 plus quarter 2, it's annualized to annual. So they are taking quarter 4 and quarter 3 of fiscal year 25. So it's annualized, okay? And you can see where are the manufacturing plants. The blue one is a manufacturing plant. So you got one here in Uttar Pradesh, one in Gujarat, and warehouses we got in Chennai, we got in Maharashtra and Punjab also. Okay, the two manufacturing plants are there, Uttar Pradesh and Gujarat. Then esteemed clients. Who are the clients? First of all, we see automobile companies, Audi. Okay, we got BMW, we got GM, Volkswagen, Toyota. Then we got in forgings, Allied Group. Is that steel? Mid steel, okay. Mid steel. And we got domestic clients, of course. We also got engineering structures, domestic clients. Reliance is one of them. BHEL is one of them. Indian Oil is one of them. Larsen and Toubro is also. So construction companies are being catered to. Automobile companies are being catered to. Steel companies, oil companies are being catered to. Okay, global presence. Now, how much money is coming from where? Okay, in H1 fiscal year 26, or let's go to fiscal year 25. In fiscal year 25 alone, 25% of revenue came from exports, 75% came from domestic. And these are the places where they're selling: US, Canada, Russia, UK, New Zealand, even New Zealand, Chile. So, almost a quarter of the sales is coming from exports, which is a good thing. Now, engineering structures and precision fabrication. So now we're going to take a look at each of the segments, what they produce and what industries they're catering to. So you can see the diversity on the total addressable market for them. More kind of industries they can cater to, more is their market. So what they can produce here: railways, roads, bridges, and girders, structures for roads and highways, technology structures, launching girders for steel and concrete girders, girder building structures. Okay, new areas of growth, special framework for elevated corridors, special form work for tunnel boring machine for high speed rail, special, okay, station buildings for high speed bullet trains, smart city structures, and the end user industries here are roads, highways, railways, telecom, boiler and turbine generators, which can be used in so many different industries like boilers and turbines, building structures, solar energies. So, number of sectors cater to clients, marquee clients from various places, and their new products can be introduced. There are new areas of growth also coming, so that's a good thing. Then in forgings, what do they make? So in forgings, they already make defense products. They're going to introduce defense products. Of course, yeah, the artillery shells are like forged. The metals forged into artillery shell shapes. So makes sense. Then aerospace parts they're going to be making gear rings, forged shafts, blind and tube sheets. And remember these aerospace parts. I think it's going to come up later in this segment. An end user, we got aerospace, defense, automobiles, nuclear power, petrochemicals, general engineering. So many different sectors. Again, extreme variety and diversity of clients can be catered to, markets can be catered to. The new areas of growths, we got stainless steel, duplex, carbon and alloy steel forgings. Okay, steel forgings, new types. one's from stainless steel, carbon alloy steels, duplex alloy steel forgings. And they're focused on manufacturing forged products and providing end-to-end solutions. So starting to end-to-end everything. They will design the products and they will manufacture and everything they will handle, the entire project. Then aerospace and defense, the future growth driver for forgings. So aerospace and defense is for forgings. And do you remember how much money actually comes from forgings? We saw here only 16% revenues come from forgings. So forgings only 16% revenues, but it's going to be new. Okay, let us see how much money they can make from aerospace and defense. So they're going to be suppliers to some of the biggest names across Indian aerospace and defense value chain. We got government PSU companies, we got medium, small, and medium sized enterprises. Medium and small sized enterprises. I've forgotten the full form of MSMEs. And then you got tier one original equipment manufacturers, okay? Suppliers to prestigious defense programs, all of them. So many different clients, private plus public, small plus big, they can do. Then, Goodluck Defense and Aerospace Limited, this is their subsidiary for manufacturing in the defense and all of that. So, first of all, they have received an industrial license under the Indian Arms Act for manufacturing artillery shells across all major calibers. So 105 mm, 120 mm, 25, 30, and 55 mm. Market outlook and opportunities, active negotiations with domestic and international defense customers. So international too, addressing rising demand for artillery ammunition and strategic significance showcases the technological excellence and precision engineering expertise. All right, okay, so it's manufacturing what artillery shells, already gotten a license for it. That's good. And they're negotiating for both clients, all types of clients, international plus domestic. In precision pipes and auto tubes, this segment, what are they offering? Different types of tubes, engineering tubes, CDW tubes, ERW, which I guess means electric resistance welded tubes, whatever that means. Then new areas of growth are also there, consistent quality products. They have been getting a lot of repeat orders. That's a good thing. It signifies customer loyalty. They have high margin products. And you can see Volkswagen, these are the clients, Mahindra, Tata Motors, the end user industries. Again, aerospace, defense, automobile, railways, fertilizers, general engineering, even wind energy. That's a fast growing segment in India and across the world. So, wind energy also. Finally, CR coils and tubes. This is the last segment. So, okay, CR means cold rolled coils and sheets they are making. And end users are railways again, road bridges and supporting structures, state governments, even central governments, and both public and private original equipment manufacturers are being catered to. So, one general point that comes up is how many different types of industries again they're selling to. Then conference con call analysis. Here we will see some statements made by management of the company telling us some more information about the future outlook for the company and some more info. So expectations for revenue and margin, profit margin for the year 2027, like fiscal year 2027. So for this year and fiscal year 2027, so fiscal year 26 and fiscal year 27, they are for a long-term growth of 15-20%, and in long term, they're going to maintain it. So the turnover of this year and the next financial year should be in line that only. And the margins, this quarter, they have propped up 9.72% of profit margins and hope margins to remain in the same space. I believe this is the EBITDA margin, 9.72%. That's a really good improvement for the 8.4 we saw earlier in the annual financial highlights section. So 15-20% is a long-term target they're maintaining for revenues as well as profits. So fiscal year 26, they expect a 15% growth. In fiscal year 27, they expect a 15 to 20% growth over fiscal year 26, and it goes on. 15-20% is the long-term growth target. Then, this is exciting, the artillery shells. Okay, so they have received the license for the artillery shells. What is the potential for revenue? Now, The artillery shell division, we have established a division for 1.5 lakh shells, and we are augmenting this capacity to 4 lakh shells per annum. Currently, established a division 1.5 lakh. They're going to be increasing the capacity to 4 lakh shells per annum. The combined revenue should be in the range of 1,000 crores. 1,000 crores. This is going to be massive, but it will not come immediately. So, this 1,000 crores, first of all, 800 crores is coming from shells, and 200 crores is coming from the missile and the aerospace. So, shells is one, aerospace and missile. Remember, defense plus aerospace is a new growth engine for forgings, growth driver for forgings. So, this 1,000, first of all, this 1,000 crores is going to come fully in fiscal year 28, or they're expecting it. Why they're expecting it in fiscal year 28? Because by fiscal year 28, they feel they will achieve 90% capacity utilization of the peak capacity of 4 lakh shells. So they're currently having 1.5 lakh shells. They will start making slowly and they will increase the capacity utilization. Then they're making, let's say, close to 1.5 lakh shells per annum. They increase the capacity to 4 lakh shells. That will also take some time to have that peak 90% capacity utilization, like of 90% of 4 lakh shells is being produced. So it will take time. That's why when it's all said and done, 1,000 crores they're expecting in fiscal year 28, the 30 to 35% EBITDA margin. This is gold. 30 35% EBITDA margin is way more than the current way more than their current EBITDA margins. Remember, current EBITDA margins are not even reaching 10%. They're like 8 point something percent for fiscal year 2025. So again, they're expecting this though. These are all expectations. Okay, these are not reality. These are not set in concrete. So how much revenue are we expecting from Goodluck Defense in fiscal year 26 and fiscal year 27? In fiscal year 26, we are expecting only 100 crores per revenue, and in the next year, we are expecting the full revenue from this capacity, which should be around 300 crores. So 100 crores fiscal year 26, 300 crores fiscal year 27, then significant jump up they're expecting to 1,000 crores in fiscal year 28, hopefully not fiscal year 29, but with very good EBITDA margins being expected way over. So this was Good Luck India Limited. We did not cover the cash flows, which is pretty bad. It's growing. The company is growing. They have different segments. Each segment seems to actually be catering to a wide variety of industries and clients, and is important for the company. And each of the four segments are substantial importance, have substantial contributions to revenue, which can be very much felt. And they're saying they will improve margins. They're saying they will maintain 15-20% growth. So yeah, and the new artillery shells, that's exciting, with way more profitable than the current one. That's what they're expecting. Let us see how the company does in the future.